3 days ago, something happened in the metals market that most people didn't notice, but the few who did immediately stopped what they were doing and started digging. Silver dropped fast, faster than many expected, financial feeds filled with reactions, traders arguing, headlines calling it another failed breakout. To most people, it looked like the same story they had seen before, another rally that couldn't hold. But the strange part wasn't the drop. The strange part was what happened afterward. Instead of collapsing further, silver stabilized. Not dramatically, not with fireworks, just quietly, stubbornly refusing to fall apart. And in markets, behavior like that often means something important is happening under the surface. Because when an asset is weak, bad news sends it lower. But when an asset is strong, even bad news struggles to push it down. That difference, subtle but powerful, is often the first signal that a larger trend may be forming. Most people never notice that moment. They are focused on the headline, the emotion of the move, the red numbers on the screen. They see the fall, but they don't see the resilience. And resilience is what changes everything. Here's something few investors realize. The biggest market moves in history rarely begin with excitement. They begin with confusion. Prices move in ways that don't quite make sense. Analysts disagree. Comment sections fill with arguments. Half the market thinks the trend is over, while the other half suspects it might only be starting. That is exactly the kind of environment we're in right now. To understand why some analysts believe silver could be entering a very different phase, you have to forget the last few weeks and go back much further. Decades, not months. For nearly 50 years, silver behaved in a way that trained investors to underestimate it. Every rally seemed temporary. Every breakout faded. Over time, people stopped expecting anything meaningful from it. That kind of long-term conditioning runs deep. Markets don't just move numbers, they shape beliefs. And once a belief becomes widespread, it takes a powerful shift to break it. But history shows something fascinating about commodities. The longer they stay quiet, the more dramatic the move tends to be when they finally wake up. Think about how pressure builds beneath the surface of the earth. For years, nothing happens. Then suddenly, the ground moves. The energy wasn't created in that moment. It was stored slowly over time. Markets work in a similar way. Long periods of stability often hide structural changes. Supply shifts gradually. Demand evolves quietly. New industries begin using materials in ways that weren't common before. None of it feels dramatic while it's happening. Until one day, the balance tips. Silver is one of the few metals that sits at the intersection of two powerful forces, industry and finance. It is used in electronics, medical technology, and renewable energy, but it has also been viewed as a store of value for thousands of years. That dual role makes it unusually sensitive to changes in both the real economy and the financial system. When industrial demand rises, silver feels it. When investors begin looking for alternatives to paper assets, silver feels that too. And when both forces start moving in the same direction, the effects can be significant. Right now, analysts are watching several signals that suggest the environment around silver may be shifting. Not overnight, not in a straight line, but gradually and persistently. Demand in key industries has been climbing over the past few years. Mining supply has struggled to grow at the same pace. Inventories in some segments of the market have tightened. None of these factors alone guarantees a major price move, but together they begin to form a pattern. Patterns are what experienced investors pay attention to, because markets rarely repeat in exactly the same way, but they often rhyme. There have been moments in the past when silver moved quietly for years, almost forgotten, only to surge rapidly once the underlying conditions aligned. Those moves didn't begin with headlines. They began with subtle changes in behavior that only a small number of observers noticed at first. That's what makes the current situation interesting. Not because anyone can predict the future with certainty, but because several of those subtle signals are appearing again. And when multiple signals appear at the same time, the probability of a larger shift increases. Of course, no market moves in a straight line. Volatility is part of the process. Corrections shake out short-term traders. Doubt spreads. Confidence returns slowly. But beneath all of that noise, long-term trends continue to build. What matters is not the daily fluctuations, but the underlying direction. And right now, the underlying direction is what has analysts paying attention. Not because silver is already at extraordinary levels, but because the structure of the market appears to be changing in ways that don't happen often. The real story, however, isn't just about price charts. It's about what's happening behind the scenes, in supply chains, in industrial demand, and in the quiet shifts taking place in how investors think about tangible assets. And those deeper signals are beginning to tell a story that most people haven't noticed yet. Most people think major financial changes arrive with headlines, alarms, and official warnings. In reality, the biggest shifts usually begin quietly, almost invisibly, while everyone is distracted by something else. Markets rarely shout at the beginning of a trend, they whisper. Over the past few months, something unusual has been happening in the silver market. Not the kind of move that dominates television coverage, but the kind that experienced traders watch very carefully. Price behavior has changed, volatility has increased, and more importantly, the way silver reacts to news, corrections, and macro events is no longer behaving the way it did for decades. For nearly half a century, silver had a reputation. It was known as the frustrating metal. Every time momentum started to build, the rally stalled. Every breakout seemed to fade. Investors would get excited, only to watch the price retreat again and again. That pattern conditioned an entire generation to believe that silver simply wasn't capable of sustaining a major move. But markets, like people, eventually break out of old patterns. To understand why some analysts believe silver could be entering a very different phase, you have to zoom out and look at history, not just the last year or the last cycle, but the broader rhythm of commodities as a whole. Many commodities spend long periods in consolidation. Sometimes those periods last decades. During that time, supply adjusts slowly, demand evolves quietly, and pressure builds under the surface. Then, often suddenly, the equilibrium breaks. When it does, prices don't move gradually. They reprice. This has happened repeatedly across different sectors. Energy markets have experienced it. Agricultural commodities have experienced it. Industrial metals have experienced it. Long periods of stagnation, followed by relatively short bursts of dramatic movement. Silver, interestingly, has spent more time in stagnation than most. For years, analysts debated why. Some pointed to the structure of the market. Others pointed to industrial demand cycles. Some argued that silver simply lacked the monetary demand that drives gold. But regardless of the explanation, the effect was the same. Long stretches of sideways movement that discouraged long-term conviction. That's what makes the current environment so interesting. In recent months, silver has shown behavior that suggests a shift in market structure rather than just another short-term rally. Corrections have been sharp but brief. Support levels have formed higher than previous cycles. And perhaps most telling of all, the narrative around silver is beginning to change. Narratives matter more than most people realize. Markets are driven not just by data, but by perception. When enough participants begin to see an asset differently, capital flows change. And when capital flows change, price trends often follow. Right now, the perception of silver is evolving from a speculative metal to a strategic one. Part of that shift is coming from industrial demand. Silver plays a role in electronics, renewable energy technologies, medical equipment, and advanced manufacturing. As global infrastructure becomes more technology-driven, the demand for conductive metals increases. Silver happens to be one of the most efficient conductors available, which gives it a unique position in modern industry. Unlike some other materials, silver used in industrial applications is often dispersed in tiny quantities across millions of devices. That makes recovery and recycling difficult and expensive. In practical terms, a significant portion of industrial silver consumption is permanently removed from circulation. Over time, that matters. Supply, on the other hand, doesn't expand quickly. Mining projects take years to develop. Exploration, permitting, infrastructure, and production are slow processes. Even when prices rise, new supply rarely appears overnight. That imbalance between steady demand growth and slow supply response is one of the structural factors analysts are watching closely. But industrial demand is only part of the story. The second factor is monetary psychology. Throughout history, precious metals have played a unique role during periods of uncertainty, not because they produce income or dividends, but because they represent tangible value in a system increasingly built on digital and paper assets. When investors begin to question the stability of currencies, debt markets, or financial institutions, they often look for assets that exist outside those systems. Gold has traditionally been the primary beneficiary of that trend, but silver has historically followed similar cycles, often with greater volatility. Volatility in this context is not necessarily negative. It reflects the smaller size of the silver market compared to gold. It takes less capital to move silver prices, which can amplify both upward and downward movements. That's why silver rallies tend to feel sudden and intense when they occur. Another element influencing the conversation is the broader macroeconomic environment. Inflation concerns, interest rate cycles, currency fluctuations, and geopolitical tensions all shape investor behavior. When multiple uncertainties overlap, the demand for alternative stores of value tends to increase. In the past year, global markets have experienced a series of overlapping pressures. Debt levels remain historically high in many countries. Central banks continue to navigate the balance between controlling inflation and supporting economic growth. Energy prices, commodity cycles, and supply chain adjustments are still working their way through the system. None of these factors alone guarantees a major move in any specific asset, but together they create conditions where investors begin to diversify more aggressively. That diversification often includes commodities. There's also a psychological element that rarely gets discussed openly. Many investors feel they missed previous opportunities in markets like technology or real estate. When a new potential trend appears, even in its early stages, attention increases quickly. Attention eventually becomes participation. And participation, when it reaches a certain threshold, becomes momentum. Momentum is powerful because it feeds on itself. Rising prices attract attention. Attention attracts buyers. Buyers push prices higher, which attracts more attention. It's a feedback loop that has defined every major market cycle in history. Some analysts believe silver could be entering the early phase of such a cycle, not because of a single headline or event, but because multiple indicators are aligning gradually. That doesn't mean the path will be smooth. Silver has always been volatile, and volatility often increases during transitional periods. Corrections, sharp pullbacks, and periods of consolidation are part of the process. Markets rarely move in straight lines. What matters is the broader trend. Right now, the broader trend is what has professionals paying attention. Not everyone agrees on how far prices could move or how quickly. Forecasts vary widely, and responsible analysis always includes the possibility of being wrong. Markets are influenced by countless variables, many of which are impossible to predict with certainty. But even with that uncertainty, one thing is clear: silver is no longer being ignored. More institutional reports are mentioning it. More analysts are studying it. More investors are asking questions about it. And when an asset transitions from being overlooked to being closely watched, it often marks the beginning of a new phase. The question is not whether volatility will continue. It almost certainly will. The real question is whether the structural forces now building in the background will be strong enough to sustain a longer-term move. That's the part of the story that becomes even more interesting when you look at global demand patterns, currency trends, and the subtle signals emerging from physical markets around the world. And those signals are beginning to tell a story that most casual observers haven't noticed yet. To understand why some analysts are paying closer attention to silver right now, you have to look beyond daily price charts and headlines. The most meaningful signals in any commodity market rarely appear in the obvious places. They show up in supply chains, logistics reports, industrial procurement trends, and subtle shifts in how institutions behave. One of the first places professionals look is the physical market. Paper prices on exchanges tell part of the story, but the physical market often tells the rest. When demand for actual metal begins to diverge from exchange pricing, it can indicate tightening conditions that are not immediately visible in headline numbers. Over the past several years, industrial demand for silver has grown steadily. Solar energy production alone has become a significant consumer of silver due to its use in photovoltaic cells. As governments and corporations continue investing in renewable energy infrastructure, that demand is expected to remain strong, even if growth rates fluctuate year to year. Electronics manufacturing is another factor. Modern devices rely on high-performance conductive materials, and silver remains one of the most efficient conductors available. From medical equipment to data infrastructure, the range of applications continues to expand. These trends don't create dramatic headlines, but they create persistent demand, and persistent demand is often more powerful than sudden spikes because it slowly reshapes the balance between supply and consumption. Supply, by contrast, tends to move slowly. Mining output doesn't respond instantly to rising prices. Projects take years to develop, and many silver mines operate as byproducts of other metals, such as copper or lead. That means silver production isn't always directly tied to silver prices, which can create unexpected supply constraints when demand increases. Another factor analysts consider is inventory levels. Exchanges and vaults publish periodic data showing how much metal is available for delivery. While these numbers fluctuate, long-term trends can reveal whether inventories are rising or gradually tightening. Tightening inventories don't always lead to immediate price increases, but they reduce the market's margin of safety. When inventories are lower, unexpected demand surges can have a larger impact on price. At the same time, global investment behavior has been shifting in subtle ways. Over the past decade, central banks and large institutions have increasingly diversified reserves and portfolios. While gold receives most of the attention in this context, the broader trend reflects a growing awareness of tangible assets. Periods of currency volatility or uncertainty about monetary policy often encourage this kind of diversification. Investors who previously focused almost entirely on equities and bonds begin allocating small portions of capital to commodities, energy, and metals. Individually, these allocations may seem minor. Collectively, they can influence markets significantly. Another signal worth watching is the relationship between silver and other commodities. Historically, silver tends to move in phases that coincide with broader commodity cycles. When energy, industrial metals, and agricultural products begin trending higher together, it often indicates underlying inflationary pressures or supply constraints within the global economy. In those environments, monetary metals sometimes attract additional attention because they serve both industrial and financial roles. Silver, in particular, sits at the intersection of these two worlds, which makes its behavior especially interesting during transitional economic periods. Currency trends also play a role. Precious metals are often priced in US dollars, which means movements in the dollar can influence metal prices indirectly. A stronger dollar can put downward pressure on commodities, while a weaker dollar can have the opposite effect. But currency movements are rarely the only factor. Real interest rates, inflation expectations, and global capital flows all interact in complex ways. Analysts who study these relationships often look for periods when multiple variables begin aligning in the same direction. Right now, some observers believe such an alignment may be forming, though opinions differ on its strength and duration. Another element shaping market psychology is the concept of relative value. Investors frequently compare assets to one another rather than evaluating them in isolation. In the case of precious metals, the gold-to-silver ratio has long been one of the most closely watched indicators. This ratio measures how many ounces of silver are required to buy 1 ounce of gold. Over long periods, the ratio has fluctuated significantly, sometimes reflecting changes in industrial demand, investment flows, or broader economic conditions. When the ratio moves far from historical averages, some investors interpret it as a sign that one metal may be undervalued relative to the other. That doesn't guarantee a reversal, but it often becomes part of the analytical framework professionals use when assessing potential long-term trends. Market psychology is another powerful force. When an asset has spent years underperforming, many investors become skeptical of any rally. That skepticism can actually extend the early phase of a bull market because fewer participants are willing to commit capital immediately. Paradoxically, the strongest trends often begin when confidence is still low. As prices rise gradually, more participants begin to reconsider their assumptions. Analysts publish new reports. Financial media starts covering the story more frequently. Eventually, retail investors notice the trend, and participation broadens. That progression, from skepticism to curiosity to participation, has defined many historical market cycles. Technology and information flow have also changed how quickly narratives spread. In previous decades, it could take months for a shift in market perception to reach a broad audience. Today, data, commentary, and analysis circulate almost instantly across global networks. This accelerates both optimism and fear. Corrections can feel more dramatic, and rallies can attract attention more quickly. Silver, with its smaller market size compared to major asset classes, often amplifies these emotional swings. Yet beneath the short-term volatility, long-term structural forces tend to move more slowly and steadily. Demand trends, production cycles, infrastructure investments, and monetary policies unfold over years, not days. That's why experienced analysts often focus less on daily price movements and more on underlying fundamentals. They ask questions like, is industrial demand increasing? Are inventories tightening? Are macroeconomic conditions supportive of commodities? Are investors beginning to diversify into hard assets? When multiple answers begin pointing in the same direction, it can signal the early stages of a larger shift. It's important to emphasize that no forecast is guaranteed. Markets are influenced by unexpected events, policy changes, technological breakthroughs, and geopolitical developments. Any one of these can alter the trajectory of a trend, but uncertainty does not mean unpredictability. Patterns emerge over time, and careful observation can reveal them before they become obvious to everyone else. Right now, silver appears to be at a crossroads, not at the peak of a move, and not at the very beginning, but in a transitional phase where attention is increasing and narratives are beginning to shift. The real question analysts are debating is not whether silver will remain volatile. It almost certainly will, but whether the combination of industrial demand, monetary psychology, and global macro trends could create conditions for a sustained repricing over the coming years. And that question becomes even more compelling when you examine how capital flows behave during periods of economic transition and how quickly market sentiment can change once momentum begins to build. There is a moment in every major market cycle when a quiet trend stops being quiet. It doesn't happen all at once. At first, only specialists notice. Then a few analysts begin discussing it. Gradually, the topic moves from technical reports into broader financial conversations. And eventually, almost without warning, it becomes something everyone is talking about. That transition, from specialist interest to public awareness, is often the most powerful phase of a market move. Silver has not fully reached that stage yet, but there are early signs that attention is beginning to broaden. Search trends have increased. More institutional commentary has appeared in research notes, and perhaps most telling of all, discussions about metals are starting to appear in places where they were rarely mentioned before. When an asset begins to cross from niche interest into mainstream conversation, participation tends to expand. New participants bring new capital, and new capital changes price behavior. This is why momentum can accelerate quickly once it begins. Markets are not purely mathematical systems. They are social systems. They reflect human decisions, emotions, and expectations. When enough people begin acting on the same narrative, trends gain strength. One of the narratives gaining traction right now is the idea that the global financial system may be entering a period of structural adjustment. Not collapse, not crisis in the dramatic sense often portrayed online, but adjustment. Debt levels remain high in many major economies. Governments continue to manage complex fiscal challenges. Central banks are navigating the delicate balance between controlling inflation and supporting growth. These are not short-term issues. They are long-term realities that shape how capital moves around the world. During periods of adjustment, investors often reassess risk. Assets that once seemed unquestionably stable are re-examined. Portfolios are rebalanced, and diversification becomes a priority. Historically, commodities have played a role in that process, not because they are perfect investments, but because they behave differently from financial assets like stocks and bonds. That difference can provide balance during uncertain periods. Silver occupies a unique position in this landscape. It is both an industrial material and a monetary metal. That dual identity means it can respond to multiple forces at once. Industrial demand can support it during economic expansion, while monetary demand can support it during financial uncertainty. Few assets have that combination. Another factor influencing the conversation is the growing awareness of resource constraints. Modern economies depend heavily on materials that are not easily substituted. As technology becomes more advanced, the need for specialized materials often increases rather than decreases. Silver is one of those materials. Its conductivity, reflectivity, and antibacterial properties make it valuable in applications ranging from electronics to healthcare. As innovation continues, new uses may emerge that further increase demand. At the same time, mining output faces practical limitations. Ore grades decline over time. Environmental regulations become more stringent. Energy costs influence production decisions. All of these factors shape the long-term supply outlook. Supply and demand, at their core, remain the fundamental drivers of any commodity market. But fundamentals alone do not determine timing. Timing is influenced by sentiment, and sentiment can shift quickly. There is a concept in market psychology known as the recognition phase. This is the point when early adopters are joined by a broader audience. Prices may have already risen significantly, but the majority of participants are only beginning to notice. During this phase, volatility often increases. Pullbacks become sharper because short-term traders enter the market. Rallies become stronger because new buyers appear on dips. The overall trend may continue upward, but the path becomes more dramatic. Silver has historically displayed exactly this kind of behavior. For long stretches, it moves slowly and quietly. Then, during periods of strong momentum, it moves in bursts that feel almost disproportionate to the underlying news. That is the nature of a relatively small market absorbing large inflows of capital. Another element shaping expectations is the behavior of other asset classes. Equity markets, for example, have experienced extended periods of strong performance over the past decade. While many investors remain optimistic about long-term growth, some are beginning to look for diversification after years of concentrated gains. Bond markets, meanwhile, have faced their own challenges in an environment of changing interest rates. When traditional portfolio components become less predictable, the appeal of alternative assets sometimes increases.